Singapore's February export figures are seeing the first indirect effects of US trade tariffs. Non-oil domestic exports rose 7.6% last month, reversing January's decline, but falling short of estimates. Now, economists are also expecting electronic shipments to slow down in the year ahead. Nasyrah Rohim with more.
Singapore may not be on the list of direct tariffs from the US, but the knock-on effects from restrictions on China imposed in February have already hit exports. Electronic shipments, for instance, went up 6.9% last month, slower than January's 9.5%. And while non-electronic exports grew, it was mostly because of an increase in demand for non-monetary gold, which is a sign of a flee to safe haven assets amid uncertainty. Demand for gold also outpaced measuring instruments and other specialty chemicals.
Gold has been one of the asset classes that have performed well over the past 6 months, reaching record high prices in the process. So I think this could be potentially supported by continued demand, especially when there's potential for a downturn or a recession. Usually markets turn towards gold. And I think traditionally, as Asia becomes more wealthy, it has also been an asset class where investors look towards.
While US continues to be Singapore's top market for exports, the question is how long will this last? Especially as President Donald Trump has threatened to slap tariffs on more goods like pharmaceuticals. This will not only directly impact companies here, but could also affect consumer demand in the US.
Essentially, what we are waiting to see is whether US consumers are going to be paying more for the goods that they are importing from the rest of the world, and especially from, Europe, North America, China, and parts of Asia in the coming months, and whether they pull back on consumption of those goods. If they do, then for the rest of us, it may mean slower exports, slower output, lesser demand for investment, and therefore expansion, and therefore new hiring, and that will lead to slower growth.
In the coming months, analysts expect companies to cut back on buying slightly amid potential uncertainties and tougher times towards the second half of 2025.